I'm Matt Bichard with REIT.com, and joining me here at NAREIT's headquarters is Bruce Schanzer, President and CEO of Cedar Realty Trust. Bruce, thanks so much for coming in today.
Thanks for having me.
Now, you've overseen quite the transformation in your company's portfolio. Can you shed some light on what are some of the biggest challenges with that process beyond the obvious of buying and selling the assets?
So I started at Cedar a little bit less than 3 years ago. When I joined the company, I joined with our CFO, Philip Mays. And we were confronted with a challenge. Cedar was a company that had underperformed for many, many years. And it appeared to us readily that it was a company that was bloated, both in terms of having too much leverage and also having an indiscriminate portfolio. And so from a strategic perspective, one of the things that we sought out to do was to look at what we had, think about what we had, and think about what we wanted the company to look like. We recognized that our best assets were really our grocery-anchored shopping centers, and the best of those centers were the ones that straddled the Washington, D.C. to Boston corridor. Now, in thinking about our portfolio beyond the assets, we recognized we had a lot of leverage and that we needed to reduce leverage. And because we had a low share price, we also needed to do this without selling equity. And so it was a fairly challenging set of facts, and we were able to derive what I've often described as a silver bullet. We endeavored to, as you mentioned, sell a significant portion of our portfolio, basically sell everything that wasn't a grocery-anchored shopping center that was in that Boston to DC footprint. And in doing that, we were able to sell assets that in many instances had very low yields, didn't have a lot of cash flow in them. And at the culmination of that process, which believe it or not was yesterday, we actually sold our last asset last night. We have now reduced leverage from where it was in the mid-9 times on a debt to EBITDA basis when we started at Cedar, again a little bit less than 3 years ago, to under 7.3 times on a pro forma basis for that sale.
And the expansion of e-commerce is obviously an issue that retail landlords across the country have had to deal with. In your space, in the grocery-anchored centers, are you seeing much of an impact from e-grocery retailers? And do you foresee a time when grocers may need to adjust the customer experience, similar to what we've seen in malls?
On the grocery front, we have not seen as much of an incursion of the e-grocer concept. They have made significant inroads. For example, one of our best and largest tenants is the Ahold family of companies, Giant and Stop & Shop. They have a Peapod affiliate, which is, again, a very successful online grocer. As a practical matter, grocery is a very thin margin business, and inserting that incremental cost of delivery has so far made it not a viable strategy. One thing I know for sure is that e-commerce will only grow as a relevant part of our business and as a relevant part of the businesses of our tenants. It'll certainly grow in the grocery space as they solve some of the challenges that the e-grocer model faces right now.
So Bruce, moving away from e-commerce, what are some of the big picture type things that you're thinking of that could take its place in the next 5 to 10 years?
We think about things like aging baby boomers, right? The fact that we're seeing this massive demographic trend where people will no longer, a significant portion of the population will no longer be in the workforce. What will that do to consumption habits? What types of retailers will be successful in the face of that type of a population? We're seeing younger people becoming more urban. How will that impact retailing? And then, even things as far-fetched as driverless cars, right? We see Google working on driverless cars. Within the next 10 years, I assure you, that's something that we're going to be talking about. What will that do to our parking lots? What will that do to our GLA requirements? What will that do to the way retailers operate their businesses? So again, these are the things that we actually think about because we build 10-year return analyses, and I say to myself, in 10 years from now, will this parking lot that we're spending money on need to be restriped because driverless cars are suddenly going to be pulling into these parking lots? And so again, e-commerce is definitely an element of the business. It's something that's growing. Bricks and mortar will always be relevant, but I think that the key to a successful business such as ours is really to anticipate the challenges coming down the road and to make sure your business is nimble enough to be able to address them.
And lastly, picking up on that, you've said in past interviews that Cedar's now at a position where you're ready to switch from defense to offense. Where are some of the places where you're seeing the best opportunities?
Over the next 3 years, a significant proportion of our portfolio is rolling. It's one of these just coincidences that happens to work very well for us because we have the opportunity in this recovering economy to release a significant proportion of our space with very little capital spend, where we project that we're going to get positive cash spreads of 8% or better. So again, this is a way for us to really just improve our earnings without significantly investing capital. Now beyond that, I would describe our shift from defense to offense into really two buckets. One is that we're going to be leaning a lot more into investing back into our centers. People talk about redevelopment. We're a relatively small company. We're targeting significant capital spend back into our assets in which we contemplate generating double-digit internal rates of return. So when you think about the type of NAV growth and earnings growth that will engender, that will be pretty significant. I would say that will support a second leg of our defense to offense strategy, which is that we're going to be selling the weaker assets in our portfolio and really focusing on acquiring much higher quality assets, again, within the DC to Boston footprint and focused on grocery anchored, but really trying to get into better demographics, higher density markets, and admittedly, from an FFO perspective, that will be dilutive. But we think that will be dramatically accretive to NAV over the long term in terms of the kind of growth that will engender. And for our shareholders, we're going to develop a portfolio that is going to be much more attractively situated within the capital markets, that will attract institutional capital much more readily, and that we think will be a stronger performing portfolio for many years to come.
Bruce, thank you so much for joining us today.
Thank you, Matt. I appreciate it.
For more on this and other real estate news and analysis, be sure to visit REIT.com.